Imagine logging into your brokerage account, right? You're looking closely at your private credit portfolio and seeing that a company you backed, a real, tangible business making specialty hot sauce, just got written down to absolute zero.
Oh, yeah, complete and utter wipeout.
Exactly, a total wipeout. I mean,
Right.
if you're holding BDC stock right now, hearing that a non-accrual asset just went to zero is probably making your stomach drop.
Oh, absolutely.
You'd expect the rest of your NAV to be bleeding out right alongside it. But what if I told you that despite taking a total loss on that specific asset, the core portfolio was sitting almost exactly at its original cost?
Kind of hard to believe, honestly.
Right. Well, welcome to the deep dive. Today we are breaking down the financial firewall of Saratoga Investment Corp.
And we have an incredibly revealing stack of sources to work through today. We are pulling straight from Saratoga's Q1 FY 2027 shareholder presentation and their financial results press release.
Which covers the quarter ending May 31st, 2026, right?
That's the one. And what makes this particular quarter so fascinating is that it acts as a perfect microcosm for the pressures facing the entire middle market lending space right now.
Yeah, and the mission for you today is pretty clear. We want to unpack the anatomy of a middle market lender that is operating in a, well, highly volatile, highly uncertain economy.
Definitely.
We're going to bypass the surface level PR speak and discover exactly how a firm balances the need for total portfolio growth against the harsh, undeniable reality of market write-downs.
Because there's really no hiding from those write-downs right now.
Right. We want to know what their specific survival tactics tell us about the broader private credit sector. Okay, let's unpack this. We need to start with the baseline performance because, before we look at the casualties, we need to know if the broader ship is moving forward.
Yeah, and if we connect this to the bigger picture, the top line numbers show a company that is refusing to just sit on its hands.
Meaning they're actively deploying capital.
Exactly.
Yeah.
I mean, if you look at their AUM, their assets under management grew to $1.126 billion.
Over $1 billion. Wow.
Yeah, and that's a 1.6% increase just for the quarter. But more importantly, it represents a 16.3% jump year over year.
That is a massive year-over-year leap.
It really is. And they achieved that through robust net originations. We are talking about $79.2 million in new originations put to work across 2 new portfolio companies and 10 follow-on investments.
But wait, we have to factor in the churn there, right? Because a huge chunk of that was just replacing capital that walked out the door.
Right. You always have to look at the net number.
Yeah. They had $48.4 million in repayments. So despite a massive wave of companies repaying their loans this quarter, Saratoga successfully pushed that capital, plus an additional $30.8 million in net originations, back out into new deals.
Which is an incredibly difficult maneuver in the current macro environment. I mean, CEO Christian Oberbeck's notes specifically highlight a severe sector-wide pressure across private credit.
So it's not exactly easy out there.
Not at all. The sentiment is super cautious, the market dynamics are fiercely competitive, and deal flow for high-quality assets is really constrained.
Which actually brings me to a metric that I really need to challenge you on.
Okay, let's hear it.
So the sources proudly state that Saratoga's LTM, their last 12 months return on equity, sits at 4.0%.
Yep, 4.0.
And yes, the presentation points out that this beats the BDC industry average, which is currently sitting in the basement at a dismal 2.4%. But let's be totally real here.
I feel a but coming.
Right. If I'm taking on the illiquidity, the default risk, and just the sheer complexity of a middle market BDC, a 4% ROE feels incredibly light.
Sure.
I mean, I can practically get that yield in a risk-free money market fund right now without losing sleep over whether a hot sauce company is going to default. So why should investors cheer for a 4% return?
Well, if you look at that 4.0% in a vacuum, your skepticism is completely warranted. I mean, no one is targeting private credit for a 4% return. But an LTM metric, looking backward over the last 12 months, is essentially a snapshot of a market in a deep freeze. The 4.0% isn't a long-term target. It's a testament to relative survival.
Okay, relative survival. I like that phrasing.
Yeah, because when the broader BDC industry is suffocating at 2.4%, printing a 4.0% means your underwriting is holding up significantly better than your peers during a worst-case scenario. It's like,
It's like that student who usually gets straight A's, right? But then brings home a C+ on a wildly difficult exam where the rest of the class got D's and F's.
that is a perfect analogy.
Yes. So the victory isn't the absolute number, it's the delta between them and the rest of the street.
Precisely. And, you have to zoom out to see the real engine. If you look at their average return on equity over the past 12 years, you see a highly consistent 10.1%.
Okay, so double digits historically.
Right. And the industry average over that same 12-year period is just 6.7%.
Yeah.
So they have a long, proven track record of generating that double-digit yield you're looking for and doing it with a massive premium over their peers.
I see.
The current LTM drop, which is down from 9.1% last quarter, by the way, is a reflection of immediate macroeconomic weather, not a sudden flaw in their historical underwriting model.
Okay, I'll buy that the historical premium is intact. But that immediate macroeconomic weather is causing a very real mathematical paradox in the current quarter's sources.
How do you mean?
Well, we just established that their AUM is growing. They have more assets working for them than they did last quarter, yet their per-share income metrics are shrinking.
Yes. The profitability squeeze.
Exactly. Adjusted net investment income, or NII per share, dropped to 47 cents this quarter, down from 53 cents. NAV per share dropped 4.9%, falling from $24.42 down to $23.23. Now, they maintain their 75-cent quarterly dividend, which is paid out in 25-cent monthly installments, which is great for that 14% yield.
Very attractive yield, yeah.
But the core profits driving that dividend are clearly under pressure. So if the base engine is managing more money, the only way per-share profits drop is if they are getting squeezed on the margins. Are they just writing cheaper loans to stay competitive, or is the broader interest rate environment dragging them down?
It's actually a brutal combination of both, and it's exacerbated by some really frustrating timing dynamics.
Oh, timing is always the silent killer.
Totally. But let's look at the actual core net interest margin first. The raw dollars they made on their interest spread actually increased slightly to $13.4 million this quarter.
Okay, so the core engine is generating more total revenue.
Yes, driven by a 4.8% increase in average core assets. But that per-share squeeze, that's being driven by three relentless headwinds.
All right, break those down for me, because this is where the mechanics of private credit really come into play.
Okay, headwind number one is the trajectory of SOFR base rates. The average SOFR rate used across their portfolio decreased by 5 basis points from last quarter.
Just 5 basis points, that doesn't sound like much.
It doesn't, but in a floating rate portfolio, when that benchmark ticks down, the top-line interest you can charge on your existing loans immediately compresses.
Oh, right. You don't have to rewrite the loan. The yield just drops mechanically.
Exactly.
The double-edged sword of floating rates. It prints money on the way up, but the moment the central banks even hint at easing or the benchmark naturally drifts down, your top-line revenue just gets shaved right off.
Yep, and that leads right into headwind number two, which is the brutal reality of current spread compression on new loans.
Spread compression, because everyone is fighting for the same deals.
Precisely. Because deal flow is constrained, lenders are fighting tooth and nail over a smaller pool of high-quality borrowers. The borrowers know this, so they demand better terms.
Of course they do.
As a result, the interest rate spreads on the new originations Saratoga made this quarter were almost 50 basis points lower than the older repaid assets they replaced.
Wow, 50 basis points. That is a fascinating dynamic. So when Saratoga got that $48 million in repayments we talked about earlier, it wasn't necessarily a good thing.
Not at all.
They had to take that capital, which was previously locked in at a juicy high-yield spread, and redeploy it into a hyper-competitive market where they had to accept a 50 basis point haircut just to win the deal.
Right. They are actively replacing high-yield legacy assets with lower-yield new assets just to keep the capital deployed.
Just to keep it moving.
That's rough.
It's the ultimate redeployment trap in a tight market. And then the third headwind compounds this even further.
Which is the timing you mentioned.
Exactly, timing. This is the simplest but often most overlooked drag on NII. Imagine a massive repayment hits the books on day one of the quarter. Saratoga now has a mountain of cash.
But due to the rigorous due diligence required, they might not originate the replacement loan until, say, day 80 of the quarter. For those 79 days in between, that capital is sitting idle, earning a minimal cash yield instead of a massive private credit yield.
Ah, that perfectly explains the NII squeeze. The pie is getting bigger with AUM growth, but the margin filling inside each slice of the pie is getting undeniably thinner.
That's a great way to visualize it.
But NII is just the income side of the equation. We need to talk about the balance sheet side, because the NAV dropped by $1.19 per share.
It did.
And the sources indicate that 28 cents of that was just due to under-earning the dividend, but a massive 93 cents per share came directly from unrealized depreciation on their investments.
Yeah, and to put that in dollar terms, the total portfolio was marked down $15.2 million this quarter.
Ouch.
And if we strip out the CLO investments and look specifically at the non-CLO core portfolio, the net unrealized depreciation was $18.3 million. That is a very significant hit to book value.
So we just established that the macroeconomic environment is tough, but a markdown of that size means specific things in the portfolio literally lost value. Let's look at the actual blast radius here. What broke?
Well, the sources are highly transparent about the casualties. The most glaring is Pepper Palace.
The specialty hot sauce retailer.
Yes. This quarter, Saratoga's investment in Pepper Palace was written down to absolute zero.
Wow.
That is a $3.9 million markdown isolated to a single company, and the asset remains on non-accrual.
Meaning they aren't collecting a single dime of interest on it, and the principal is assumed entirely wiped out.
Nothing. Complete wipeout. Then you look at Exigo, which was moved down from yellow to red status in their internal tracking.
Red status is never good.
No, it's not. Exigo is now carried at $17.3 million, which means it has been marked down to just 70% of its original cost.
Yeah.
You also have Cronus, which was marked down by an additional $1.5 million.
Okay, so those are acute operational failures at the company level. But the shareholder presentation actually segments that $18.3 million core depreciation into three distinct categories, right? And I think this breakdown is vital for anyone trying to understand how BDC portfolios are actually valued quarter to quarter.
It provides immense clarity because 54% of that total depreciation came from the specific company performance issues we just walked through, the Pepper Palaces and Exigos of the portfolio.
But then 33% of the drop, which is roughly $6 million of that total hit, was categorized as a broad market adjustment to comparable multiples.
Right.
And the final 13% was attributed to market spread changes. Let me think about this using a residential real estate analogy.
Go for it.
That 33% multiple adjustment, that is like the estimated value of your home dropping on Zillow because your neighbors suddenly started selling their identical houses for 10% less. Your foundation is solid, your roof is fine, you are paying your mortgage on time, but the broader neighborhood valuation just cooled off. BDCs mark their private books against public comparables, so if public multiples drop, the private book takes a paper hit.
Right. It's an external macroeconomic valuation pressure.
Right.
Doesn't mean the underlying company is missing its debt payments.
Exactly. But that 54% performance adjustment, that is like your home's value dropping because the roof literally caved in and the basement flooded.
Yep.
That is Pepper Palace. The business itself is structurally impaired and the value destruction is permanent.
What's fascinating here is how this highlights the broader context of Saratoga's portfolio, which is absolutely incredible. Think about the math here.
Okay.
You have a total wipeout of an asset to zero. You have a 30% haircut on a major position like Exigo. You have $6 million evaporating just from public multiple compression.
It sounds like a disaster.
It does. And yet, when you look at the core non-CLO BDC portfolio as an aggregate whole, it is currently sitting just 0.2% below its original cost.
That statistic stopped me in my tracks when I read it. Even with a literal zero on the books, the aggregate portfolio is hovering practically at par. The rest of the assets must be performing flawlessly to absorb a blow like that without dragging the entire NAV into the abyss.
It speaks entirely to their firewall. If you are facing a reality where tangible businesses can collapse to zero, your immediate concern is containment. How do you stop that single sinking ship from taking down the fleet?
Let's look at the architecture of that firewall. How is the rest of this portfolio insulated from the defaults that are clearly starting to pop up across the sector?
Well, it starts with their internal risk rating system. Despite all these macro headwinds, 98.3% of their loan investments currently hold their absolute highest internal rating.
98.3%. Wow.
Yeah, and that percentage actually increased from the previous quarter. Furthermore, they're non-accruals. The loans that are totally dead in the water, like Pepper Palace, sit at 0.0% of fair value and only 1.2% of total cost.
I want to frame that 1.2% against the broader market, because the industry average for non-accruals right now is 3.7%.
Right, they are well below average.
So Saratoga's portfolio is operating with significantly less distress than the average BDC. But the real mechanism providing that safety, the actual concrete in the firewall, is where they choose to sit in the capital structure. 81.7% of their portfolio is secured in first lien debt.
Which is the ultimate defensive posture.
Hmm.
When you are first lien, you have a massive cushion of equity and subordinated debt sitting below you.
Taking the first hits.
Exactly. If a company faces distress, all of that junior capital has to be entirely wiped out before your principal is even threatened. Add to that their intense diversification. They're not making concentrated sector bets. The portfolio is spread across 44 distinct industries.
Healthcare services is their largest single exposure, and even that is capped at just 8.3% of the portfolio.
That's very well distributed.
So if new regulations torpedo the healthcare sector tomorrow, 91% of their portfolio is completely insulated from the blast. But there is another defensive layer in the sources that I find highly controversial, and I really want your take on it. Their liquidity pile.
Ah, yes. It is massive.
They were sitting on $196.8 million in available liquidity right now. That includes $60.8 million just sitting in pure cash and cash equivalents.
Yep.
And they actually bolstered this war chest by issuing $25 million and 7.25% baby bonds back in April. So here's my issue with this. We just talked about the NII squeeze.
We did.
We talked about a 4% ROE. With over $60 million just sitting in cash, earning a fraction of what a private credit loan would yield, and borrowing money at 7.25% just to hold it, isn't this cash drag actively hurting them? Are they playing it so safe that they are leaving serious yield on the table?
It's a fantastic observation because on paper, holding that much cash is a negative carry. It inherently drags down current earnings.
Right.
But you have to view that liquidity not as an idle mattress, but as an active strategic weapon. CEO Christian Oberbeck's commentary makes it clear that in a market where default rates are rising and uncertainty is high, a lot of their competitors are freezing up.
Oh, interesting.
They're licking their wounds, dealing with their own bloated non-accruals, and pulling back from lending.
So their competitors are stuck playing defense.
Exactly. But if you have nearly $200 million in available liquidity, a pristine balance sheet, and a strict focus on first lien debt, you have ultimate option value. Having that cash allows Saratoga to deploy capital aggressively and accretively when others are forced to retreat.
Because they have the funds ready to go.
Right. When a fantastic middle market company needs funding, and the usual lenders can't step up because their balance sheets are stressed, Saratoga can walk into the room, demand excellent terms, and dictate a much wider interest rate spread.
So it's dry powder. They are absorbing a slight yield drag today, so they have the ammunition to capture massive premiums when the market eventually capitulates.
They nailed it.
They can navigate the current uncertainty without ever being forced to sell their own assets at a discount. And they can pivot to pure offense the moment the cycle turns.
It's the luxury of a strong balance sheet.
Yeah.
It allows you to be greedy when others are terrified.
Okay, let's bring all of this together for you. We started this deep dive wanting to understand how a middle market lender operates when the economic waters get violently choppy. What the data from Saratoga Investment Corp reveals is a company facing undeniable, heavy macroeconomic headwinds.
Absolutely undeniable.
We see that clearly in the shrinking SOFR rates, the brutal spread compression on new loans, and the resulting squeeze on their net asset value and net investment income. We also saw that this environment is claiming real victims, evidenced by the total wipeout of Pepper Palace.
But the defining takeaway isn't the presence of headwinds, it's the structural resilience required to sail through them.
Exactly. Their strict underwriting discipline, their overwhelming focus on first lien debt, their meticulous diversification across 44 industries, and their massive strategic liquidity reserves. These defensive mechanisms are the reason their core portfolio is absorbing a total loss and still sitting essentially at cost.
It's a masterclass in risk management.
It really is. It's why their historical ROE continues to significantly outpace the BDC industry average. They aren't trying to outrun the storm, they've just built a ship that is structurally incapable of sinking.
And as we wrap up, there is a final, highly provocative thought buried in the source material that I think you really need to mull over, especially if you monitor the broader private credit landscape.
Oh, what did you find?
Well, in his closing remarks, CEO Christian Oberbeck explicitly cited concerns about AI and software as a major macroeconomic dynamic causing broad valuation pressure across the sector right now. It's an observation about the sustainability of multiples in the tech space.
AI and software, the undisputed darlings of the current market cycle.
Now, contrast that with Saratoga's major write-down this quarter.
Yeah.
Pepper Palace,
Right.
a specialty hot sauce retailer. A straightforward, tangible business with physical inventory, retail footprint, and a product you can actually taste.
A business model that has existed for centuries, and it still went to zero.
Which leads to the terrifying question you need to ask yourself. Yeah. If a straightforward, tangible business with physical inventory can experience a sudden performance collapse and be written down to absolute zero in this environment, how are the massive, industry-wide, private credit portfolios that are currently stuffed to the brim with highly speculative, high-multiple, unsecured debt tied to rapidly changing AI and software companies going to fare over the next few years?
Wow.
I mean, if physical hot sauce can go to zero, what happens to those portfolios when an ephemeral software algorithm is suddenly rendered completely obsolete by a competitor overnight?
That is a chilling thought for anyone holding unsecured tech debt right now. The fallout wouldn't just be a localized markdown, it could be systemic. A huge thank you to you, our listener, for joining us on this deep dive. Keep questioning the numbers behind the headlines, always look for the first leave-ins, and we will catch you next time.